Now, to understand the market, thinking on the Iran war requires an understanding that markets are cold-hearted. The fact that negotiations broke down over the weekend is important, but it's not the most dominant input for markets. Market moves were positive even before the latest push for another round of peace talks. Wall Street stocks ended Tuesday with gains despite prevailing geopolitical risks. The S&P 500 closed to its late January peak. The tech-heavy Nasdaq 100 extended its winning streak to a 10th day. That's the longest since 2021. On Wednesday, Asian stocks mirrored those gains, with the world's second best performer, Korea, leading the way. Crude fell for the second straight day to test a low of $90 a barrel. Not too long ago, crude was threatening to break through above that $120 per barrel mark. Before the war, crude was meandering between $60 and $70 per barrel. And analysts and International Energy Agency have pointed out that the supply hit is still not fully reflected in the prices. Still, crude moves suggest an end to the war is near. Wars between regional powers are not important for global markets. The discussion on the opening of the Strait of Hormuz is more market-friendly outcome. This is driven by the theory that the ultimate ambition is to reopen the strait fully and unrestricted. The impact reaction is more nuanced. But the bigger and longer-term picture is more palatable. From a cold market mindset, even if Israel and Iran were to lob munitions at each other, markets won't care. Markets will care if the US is in the game and ramping up risk. Now, it seems that the US prefers an off-ramp. However, things could change quickly in the coming days. Whilst headlines offer little reason for optimism, markets seem to take a more wait-and-see approach rather than assuming what will happen. If anything, the glass is still half full when looking at the risk assets. But the strong performance of risk assets stands in contrast to the still elevated oil prices and rates, which raises questions about the consistency in the market pricing. Higher energy costs and monetary policy tightening should be a drag on growth and negative for stocks. But markets seem willing to look through this